So the Brits on the other side of the pond are causing quite a storm right now in the financial markets. So you can see this article titled right here, Bank of England buys bonds in bid to stop the spread of crisis. So they are very concerned of potential financial crisis within England, which is kind of already happening. And there's a lot of factors to play with this. But long story short, if you're not understanding why the market went so high in the COVID-19 pandemic or in 2020 and 2021, it's because it had a lot to do with a thing called quantitative easing, which is practically the process of government stepping in, intervening, and buying up corporate bonds and other assets. So the U.S. government, the Federal Reserves, were very committed to buying up any type of assets that will help prop up the economy. Buying bonds from credit cards, from mortgage-backed securities, treasury bills, all these different things. And what happens when bonds get bought up, the demand is higher, so what's going on, it's showing that's a higher quality bond, and the interest rates on those bonds, or practically the cost to borrow becomes way, way cheaper. Because imagine you run a lemonade stand. You have two options to raise capital. You can sell off your equity. So what that means is you're giving investors a percentage of a company. So if you watch Shark Tank, when they're like, oh, I want $100,000 for 10% stake, what that really means is their company is valued at $1 million, and they're just selling 10% in exchange for $100,000. So now they can use that money for whatever. They don't have to go pay it back. For debt, it's different. They could go get a loan, or credible companies can go raise bonds, or governments, they raise bonds as well to fund the economy. And here's an interesting thing. So Brexit has definitely been, it seems like, not actually good for the UK in regards to the financial markets. People are like, oh, Brexit's going to be amazing for the UK economy. Well, it turns out it's not really so much. So now they have a situation where the United States, and actually the Bank of England was the first ones to say they're raising interest rates. So I find this to be fascinating. Bank of England was the first one like spring. Then the U.S. decided to really get aggressive about raising interest rates, which is good to fight inflation. You can see in the U.S. right now, costs are coming down. It's very apparent. But the markets have gone down. So the S&P 500, as we're talking, we can look it up right now. Let's just go SPY, right? You're looking at let's go year to date. It's down 22%. But then look at this. Look at let's go 100 USD to pound. Where are we at? We are at a 23% gain. So if you actually think about it, if you're comparing your dollars to pounds, the market's down 23%, but actually you own the same amount of pounds with that. So you have this combination of high inflation in the UK. You have the pound is getting absolutely destroyed, 23% in a year. That's crazy, and in a recession as well. So what the Bank of England is deciding to do is they're turning to put back on the money printer. So they're like, we're going to go print more money now. And what they're going to do is they're going to be buying gilts, which if you're unfamiliar with that, it's and actually there's a crazy quote here. So let's actually read this. The Bank of England said on Wednesday it would buy long-dated UK government bonds. So those are just like treasury bills or what they call gilts over the pond on whatever scale is necessary to calm markets and prevent the financial contagion from causing wider economic damage. So here's the thing that they have a very big concern with. The fact that the pound is so much weaker now, definitely a lot of financial institutions have a risk of going, let's say, bankrupt in the UK. So, this is kind of what happened in 2007, 2008, is that a lot of institutions had a risk of going belly up, going bankrupt because the money they owed and their illiquid assets, were not going so well. So imagine, let's just imagine this, okay? You invest into a bond, and let's say you have $1,000 into your bond portfolio. And on the other hand, you have $800 of debt that is an illiquid investment. So let's say you bought some land, and that land is very hard to sell for whatever reason. Whatever it may be, right? It's an illiquid investment. And if your bond starts to go down, and obviously, let's say also those assets are in US dollars, so now your cost of borrowing is even more expensive now because the value is less, and if your bond started going down, then you get to the point where now you're belly up and you could go bankrupt. So that's what the UK is very, very concerned of. So they're deciding to, okay, well, let's try to do what we did in the pandemic, and let's do quantitative easing. Now, the issue with that is when the quantitative easing happened, I think in the U.S. the inflation rate was like 1.8%, a little less than 2%, and also we were in a pandemic. So from a humanitarian standpoint, what do you think is better? To have people in a recession, financial recession, and financially hurting when they can go outside, when they can go work and all those things, or when it's everyone's stuck at home during a pandemic? Well, the government's decided, like, you know what, it's probably better to push the recession down the road. So now that's what's happened. They've put the recession down the road. It's right now. It's happening. But now they're taking in the inflation. So the issue you have with that is quantitative easing is going to push inflation up, most likely. So this might actually be good for equities and owning stocks. So like you might see the British stock market go back up, but it could be at the expenses that the inflation continues to ride out, which this is obviously going to hurt the middle class and more poor families, and it's definitely going to be better for the rich, especially when they're cutting taxes and stuff like that. So this is an interesting scenario where, yes, in the short term the economy might get a little bit better, and maybe companies are going to get back to doing well, but this might actually just really prolong inflation, which a lot of actually fear-mongering economists worry about a thing called stagflation, which I don't necessarily believe into, but this could be a situation where you have just so many mixed, their strategy is not aligned. They're like, okay, we're going to do or we're going to cut interest rates. Okay, we're going to do this. Now we're going to cut taxes, and now because what they were actually planning to do, they were supposed to start next week to selling off their bonds. So if you hear of the U.S. reserves or the U.S. Federal Reserve saying, oh, we're going to remove assets off of our balance sheet, what they're really meaning is they're going to be selling bonds. And when you do that, interest rates go higher. You have less debt and all these things. Which is good to fight inflation, but now you can't have both. This is the confusing thing with the UK. You can't fight inflation and also prop up the economy. It doesn't work. It's like, what are you trying to do? So this could be interesting. As somebody who, let's say you work a regular job, if you have money, whatever it may be, and if you're not investing into any type of assets that go up in value, this could be very hard. So interesting. I think generally this is actually could be bullish short term and also long term, but also at the expense of having inflation, which doesn't really help anybody. So anyhow, that's about it. Hope you like this a little short clip, but it's something to definitely pay attention to.